Israel started out this whole crisis in a very well positioned, high growth rate, large FX reserves, low debt to GDP, current account surplus, high growth, low unemployment. And therefore, we had the buffer to weather a swift move in terms of lockdowns. And we also exited out of the lockdowns relatively early. And we indeed see economic activity rising in the economy. Second wave, we do not have as many buffers as we had before. And therefore, we need to be able to do not across the board lockdowns. We need to be able to do testing, tracing, isolation, localized lockdown if needed. In addition, what we didn't do very well up front is be very clear about unemployment support, various grants to business entities, and we would do well if we had drawer plans that are clear to the public what they would be entitled to in case there is such a localized lockdowns or even a more major.
You've been very active in terms of supporting the economic recovery. Is an expansion of the QE program, which at the moment is about 50 billion shekels, is that expansion on the cards to keep yields in check?
So far, it seems so. Obviously, the Bank of Israel will do what it takes to make sure and to support the economy from the tools we have, which is the Monetary Policy Committee tools. I should mention the Monetary Policy Committee had two tasks. The first one is making sure financial markets work, and financial markets were in difficult situation, both the government bond market as well as the FX market. We took swift actions, strong actions immediately, and they've been functioning well ever since. The next step is providing credit and transmitting monetary policy. As you mentioned, this we have done through this QE program, which, just to give you a perspective, is about 3 times the size of what was done during the 2008 financial crisis. We've done several other creative programs, such as giving special loans to banks to provide loans to SMEs, repos, which include absorbing corporate bonds as collateral, and we will and we lower the rate, although we didn't have much degrees there. As a wholesome package, and in particular, given your questions about the government bonds, we will continue to do to ensure that we support the economy. I believe that as long as the fiscal side, and we have to remember this is a fiscal crisis, this is a health crisis that went into an economic crisis. Most of the burden is on the fiscal side.
Sure.
As long as the fiscal support is on towards supporting the economy, supporting growth and productivity, the rating agencies will see it favorably, and therefore credit conditions should be continue to be convenient.
Governor, in terms of some of the other strategies you're following, you've been buying foreign currency for quite some time. There are questions that I'm getting from investors as to what your dynamic window is, because you seem to be operating around those parameters. What are the boundaries that you're trying to keep the Israeli shekel within?
Obviously, I would not state publicly exactly what our boundaries are, but I would say that, first of all, some of the shekel's appreciation since the big spike that we've seen as part of the, as I mentioned, the situation that happened in the drying up the dollar market at the onslaught of the crisis, has been a reflection of the fundamentals that the Israeli economy is actually exited early and relatively well out of the crisis. Having said that, most of the brunt of the crisis has happened on the domestic sector, not on the exporter sector. The last thing the Bank of Israel wants to see is the export sector having more difficulties than the reduction in world trade, the problems still within the Israeli economy, and therefore our dynamic window, I would say, has shifted to account for that. And obviously, where we see fit, we are not shy of intervening.
Governor, the last Monetary Policy Committee meeting from the Bank of Israel, well, it showed that one person was responsible for splitting the decision. And basically that person was voting for a cut to 0% on the benchmark interest rate. I want to get a bit of insight from you. Again, also given your strong and long-running academic interest in some of these fields, what do you make of negative interest rates? Do they work? Do they make sense to you?
I think the debate is still out on the negative interest rate. Do they really transmit to the type of loans that we would like to see? They clearly have some short-run effects, but obviously over the longer run, if you find yourself, I would say, with that environment for a long time, then some of the side effects that I mentioned start accumulating, whether it's in the banking sector, whether it's on other elements of the economy. And that is part of the cost benefit that I just mentioned in assessing whether that's a tool that right now is the key tool that we see that will allow credit flow to be enhanced. We believe that with the QE program that we've done, with the very low rates that we have, government bond yields right now are 10-year government bonds are at 0.75. Both households as well as businesses, as well as the government itself, are facing very convenient borrowing rates. I think a lot of it is more on the extensive margin. There are several sectors that the uncertainty that they are facing is just immense. If you are a bank, it's very hard to know whether to give a loan to, say, a company that is in the tourism business. And that's the area, and those are the segments that needed more support. And I think we need to emphasize, where can we be more creative in making sure credit goes there in a responsible way on the one hand, and on the other hand, opening up these segments in a clever yet health responsible way. Opening up the economy is still the best and most sure way to make sure that we are minimizing the damage out of this crisis.